Welcome to The Explainer. Every company tells a story with the money it spends. And today, we're going to learn how to read that story by looking at the crucial difference between two types of spending, revenue versus capital expenditure. Understanding this one little distinction can totally change how you see any business.
Let's be honest, financial reports can feel, super confusing, right? Like they're written in a totally different language. But what if I told you there's a simple secret hidden right there in plain sight? If you can just learn to track how a company spends its money, you unlock its entire strategy, its health, its ambition. It's all right there.
So to really get to the heart of a business, you actually don't need a fancy finance degree. Nope, you just need to know one thing. Pretty much every single dollar a company spends falls into one of two buckets. That's it, just two.
Okay, first up, you've got the money a company spends just to survive. We're talking about the costs of keeping the lights on, paying salaries, just opening the doors every morning. You can think of this as the cost of today.
And then you've got a totally different kind of spending. This is the money that's spent on big strategic investments. These aren't purchases for today. These are really bets on building a bigger, better, and more profitable tomorrow.
All right, to make this all click, let's leave the theory behind and dive into a simple, real-world example. Forget the spreadsheets for a minute. We're just going to tell a story.
So, let's imagine this. A small, local petrol station. It's been up and running since 2011. We're going to follow this one business to see both types of spending in action.
Okay, so first, let's look at the regular, everyday costs of just keeping the station running. The money the owner has to spend month after month, year after year, just to stay in business.
So what does that look like? Well, it's the employees' salaries, right? The monthly electricity bill, the fuel they have to buy to put in the tanks so they can sell it, and of course all the general maintenance on the pumps. These costs are predictable, and they're absolutely essential. Without them, the business just grinds to a halt.
And here is the really crucial point. The benefit you get from this kind of spending is immediate, but it's also temporary. The fuel you buy this month, it gets sold this month. The electricity is used up and it's gone. The value is basically consumed almost as soon as it's paid for, definitely within the year.
And that brings us to our first official term, revenue expenditure. That's the fancy name for all those routine, day-to-day costs that keep the business running but don't really create any lasting value or new assets.
Okay, but what happens when the owner wants to do more than just survive? Let's jump forward in our story. It's now 2021, a whole decade later, and the owner decides, you know what? It's time to stop just running the business and start actively growing it. It's time to invest in the future. So they make two really big moves. First, they rip out the old pumps and install two brand new modern ones. And second, they look at this empty patch of land on their property and decide to build a car wash, a whole new service.
Now, think about these purchases for a second. The new pumps, the car wash. They aren't meant to be used up this month or even this year. No way. These are long-term assets. They're built to generate value for, 15, 20, maybe even more years to come.
And this right here, this is a perfect example of our second key term, capital expenditure. You'll often hear people call it CapEx for short. This is the money you spend on buying or upgrading major physical assets, things like buildings, machinery, that are going to benefit the business for years, not just months.
Okay, so now that we've seen both of these in action in our petrol station story, let's put them side by side. It'll make the difference totally crystal clear and really easy to remember.
So let's just break this table down. First, the purpose. Are you just trying to run the business smoothly, or are you trying to grow it? Next, the benefit duration. Does the value disappear within a year, or does it last for many years? And finally, asset creation. Does the money you spend just vanish, or does it actually build something new and valuable for the company? That's it. That's the fundamental difference right there.
All right, so at this point, you might be thinking, okay, I get it. Different buckets for different kinds of costs. But why does this actually matter if I'm not an accountant? And that's a great question, because the answer is, this is where the real story of the company is hiding. It's because that balance, the tug of war between spending to run and spending to grow, that is the company's story. Think about it. A business with tons of revenue expenditure but almost zero CapEx? Well, it might just be treading water, stuck in survival mode. But a company that consistently, year after year, invests in capital expenditure, in its future, now that is a company that's telling you it has a plan. It's telling you it's here to win.
So the next time you look at a company's expenses, you won't just see a bunch of numbers on a page. you'll see choices. You'll be able to ask the most important question of all. Is this company just paying today's bills, or is it busy building tomorrow's empire?